Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to be discussing America's stagnant housing market, stock market volatility, inherited Roth IRAs, IRS final regulations, and a look at the Plan Solutions Incorporated Office Bulletin Board. And of course, if you want to subscribe to the podcast, please hit that button right now and do so on whatever platform you're on. And if you want to get subscribed to the Personal Financial Review, the content that we discuss here, please send Katie an email. That's KATIE at plansolutions.com and subscribe today. Mr. Armour, how are we, good sir?
Doing well. Yeah, we've had a little bit of volatility here in the stock market, but seems to be bouncing pretty good today on a positive jobs report. So hopefully that means things are settling down a bit.
Absolutely, yeah. We're going to get into some of that, but let's start with America's stagnant housing market. And we talk frequently about the housing market and, of course, interest rates. We've seen what's going on there, permits to build and so on and so forth. So, what's really our overview? Where are we at as of the middle of 2024 with the housing market?
Yeah, really, it's kind of interesting just since we wrote this article, things have changed a bit. But, the theme is just where mortgage rates are at, right? I mean, at the time of the writing, mortgage rates were at 6.81% for a 30-year mortgage. 6.31% for a 15-year mortgage. Obviously, much, much higher than what we saw during the pandemic, where, a lot of people were able to lock in rates of 3%, or in some cases, even a little lower than that. So, we've seen rates more than double. Now, on the bright side, as I mentioned, we had a little volatility here in the stock market. Well, we also saw long-term interest rates come down quite a bit, which causes bond prices to go up. And, that feeds through to the mortgage bond area as well. And when mortgage bonds go up, interest rates come down and, starting to get a little bit better financing rates. So it'll be interesting to see how that trend plays out. And maybe it will help with, as you said, the headline, America's stagnant housing market, where they're just, we're not seeing a whole lot of activity compared to past time periods.
Yeah, it's a really interesting time. I mean, well, we've kind of hit an anomaly time with what happened with the pandemic and a lot of the policies and how that affected everything, inflation, et cetera. But you mentioned as far as, the Fed's doing something, are we seeing more with just the long-term rates as far as like 30-year fixed, or are we seeing it with the 15-year terms as well, that things might start to adjust?
Yeah, across the board, we've seen rates coming down a bit, but again, we need to see some more of that because they're basically still high. And a big part of the problem is those low mortgage rates from the pandemic, or in some cases even before that. I mean, a lot of people locked in, interest rates in the 3% range. Or, either because they purchased it during the pandemic when a lot of people were, a lot of demand for homes, or they refinanced and locked in those low rates. And so, in essence, no one wants to give up that low interest rate. So people are much less likely to move because they'd have to, give up their 3% interest rate and take on a 6% interest rate. And the added cost, of their monthly mortgage would be significant.
Absolutely.
Now, on the bright side, mortgage rates did hit as high as 8% in late 2023. So the fact that, they're now down below 7 and seem to be trending down even further, that may help to some degree. But it still makes buying a new home for first-time home buyers really expensive, but also for anyone looking to trade up. If you're looking to sell your home and trade up to that new, more expensive home, not only, is the home going to cost that much more, but with the higher interest rates on, the existing mortgage balance plus whatever additional amount you may need to take to trade up can really create a big increase in that monthly payment that, I'm thinking a lot of people either just don't want to take that on or thinking they can't afford it.
Yeah, well, what are we seeing as far as with higher interest rates, are home prices coming down? Or, we've talked about a lot of different factors, not as many new homes being built, people not wanting to move. But has the higher interest rates affected home prices as far as coming down any? And if not, is that unusual?
Right. Yeah. A lot of people predicted with how much interest rates went up that we'd see home prices dip. The idea being that, okay, people just can't afford to pay that much, so there'll be less demand. Obviously, there'll be some forced sellers, right? Either because somebody has to move for work, or let's say someone passes away and the trustee or executor is selling the home, right? So they just have to basically, take whatever price the market will give. But that hasn't happened. In fact, in May, the median price of an existing home reached a record high of 419,000 nationally. So, and of course, we're seeing, highs in most markets. Instead, what's happened is just the number of transactions has really dropped off. Thus, the stagnant housing market, because people just are just waiting and staying put and saying, okay, we'll just hold on to this low interest rate and wait this out and maybe see if prices dip, although it doesn't look like that'll be the case, or maybe see if interest rates start to move back down, which hopefully if the recent trend continues, that we might find more of a middle ground where, maybe we won't get back down to those 3-4% interest rates, but maybe if we get down into the 5% interest rate environment, people will look at it and say, okay, even though it is going to be more expensive, because of personal reasons or other needs, that it's still worth, selling their house and buying up or buying a new house, even if that means that payment's going to go up a bit.
Yeah, that makes me curious. Has there been is this an unusual circumstance? Have we seen this before?
It is an unusual circumstance. You really have to go back to the 1960s
Wow.
to see a similar time period, or really, I guess, late 60s, early 70s. Interest rates were very low in the 60s. And so again, a lot of people locked in mortgage rates at really low levels. And then when we started having the inflation of the 70s, kind of similar to what we've experienced, we saw interest rates go up a lot. And so you saw a similar impact where, yeah, a lot of people were very hesitant to give up their low interest rate mortgage. Now, the difference is in the 70s, you still had quite a bit of building and activity because the baby boomers were coming of age and buying. You had this big population cohort coming through, and even at high interest rates, right? I'm sure you've heard from a lot of people like I have. Talk about my first mortgage was at 14%, right? This is nothing. Well, yeah, you had a big group of people that were forming households, wanted to buy, even though interest rates were high. Although back then you didn't necessarily see the price appreciation that we've seen because there was that added supply. And supply has been low to materialize in the current environment. Again, partly just because, with where prices are, with where the cost of building materials are, and with where interest rates are, I think home builders are very hesitant to, increase supply too much and risk oversupplying the market. Not because there's not the demand for homes, but there's just not the affordability there.
Yeah. Well, and when it comes to affordability, what are we seeing maybe as far as the median income for households, be it individuals, families that can even purchase homes? I mean, prices have continually gone up, and with the economy, I could see it being so much harder for folks to get into a first-time home.
Yeah, I know we've touched on this in past podcasts of different, especially different municipalities where the affordability is just, hitting really poor levels, like crisis type levels. But and it's not as bad now, or it's not as bad nationally, but still, you look if you look at median prices. So prior to the pandemic, the median home price was about 270,000. As I said, now it's closer to 420,000. So we've seen a big increase, and with the increase in interest rates, it's currently estimated that a household earning $100,000 can only afford 37% of available homes. And that's, compared to the typical of 62%. So yeah, we're getting down to that point where you basically have, half of the potential buyers or pretty close to that, that are just locked out of the market due to affordability issues.
Now, is that 37%, is that nationally?
Yes. We're just looking at national numbers. I mean, obviously, we're in California, can be very different, even within California, much less looking at some of the metropolitan areas where that median, housing cost is much, much higher, but also the average income is, right? Whereas there's a lot of places where housing is more affordable and it kind of balances out, which is why we're seeing a lot of migration. People out of California going to some of these lower cost states where their money goes a lot further and affordability is less of an issue. But even, the national average, it's still showing some real challenges.
Yeah. Well, in wrapping this up, do we see these problems persisting? Is it too early to tell?
Yeah, I think to a degree the problems will persist until we see some type of normalization in interest rates. Again, not to say interest rates are going to have to go all the way down to those pandemic lows, but we need some type of middle ground between where we've been, where we were during the pandemic, then where we were at the peak inflation period where mortgage rates were really high. We probably need to find somewhere there in the middle where supply and demand meet, and it unlocks, this housing market, and that more people are willing to sell, more home builders are willing to take on some risk and build out to meet that supply because they believe that the demand will be there at those price points, to really get things moving again.
All right. Well, let's jump over to stock market volatility. I mean, the U.S. stock market, we talked about it. It started strong. We had some really good signs. But I think we had some interesting news recently as far as how the stock market's going. But I think maybe people over panicked a little bit here, or the news likes to sensationalize a little bit extreme. I'm not really sure, but this isn't an unusual occurrence. I think that's the thing.
Yeah, absolutely not. This is totally normal, at least what we've experienced so far, right? I mean, if we take bigger picture, the stock market started the year really strong. It made a full recovery from the 2022 losses in January, and then it's gone on to make a series of new all-time highs in the spring, and then through again in the early summer. So yes, we did see a bit of market volatility. It got people's attention because it dropped really sharply over the span of a few days, and so I think that was something that jumped out. But really, these short-term adjustments are pretty normal, right? They're not necessarily a sign of negative returns to come. I mean, if you think about it, this has been a high volatility year. No one worries about volatility when it's to the upside, right? We like that volatility to the upside. But generally, that also means you're going to have some increased volatility to the downside when those corrections happen. And in the majority of years, the stock market will experience a decrease of at least 10% from its previous highs. And we haven't had that yet. Even with this sell-off, we're not quite there. So maybe it could get a little bit worse in the short term, but that doesn't mean that the longer term trend has shifted. In fact, even if you look at last year, last year was a really strong year for the stock market, but from the end of August to about the middle of October, we had about 11.5% pullback. So a lot of people, don't remember that because the market rallied really strong the last month and a half of the year and finished at new highs and, posted a really good return for the year. So they don't remember, yes, we had this pullback and like in a lot of years where if you have good up years, you're going to have this kind of larger pullback, larger period of market losses. It doesn't mean that it's that the trend has shifted.
Yeah. Well, you mentioned a lot about the sell-offs happening and some of these other occurrences. And these are, I mean, like you said, they're quite normal occurrences, and there's reasons behind them that are very valid that are actually could be a positive sign.
Yeah. I mean, really, we don't want the stock market to go up too quickly, right? I think most people would prefer to have a longer cycle of more consistent returns over time rather than a shorter cycle where you get really strong returns and then, things start getting overpriced, bubbles start to form, and then we're back into a recession, downturn, et cetera. So when the market is doing really well, these corrections can be a good thing to kind of slow down that pace. And even with the correction, if you look at the market returns, over the first 7 months of the year, and you extrapolate if it were to stay at that pace, even after this correction for a full year, we're still looking at an above average year in terms of stock market returns. So things just went from really good to good. It's not anything to worry about, but I think the speed of the market decline got people's attention. But it's also important to understand that's also normal. There's a saying on Wall Street that the market goes up the stairs but down the elevator. And we spent a lot of months this year kind of slowly grinding up the stairs. But when it corrects, it typically goes down pretty quickly. That's not an unusual thing. It's just part of the normal type market patterns that we often see.
Yeah. Are there any sectors of the market that are maybe a little worrisome, or some that are outperforming even expectations at this point, even with some of the sell-offs and a little slightly downturn, so to speak?
Yeah, I don't think there's any areas specifically that are really worrisome. I mean, the big performers, the tech companies, specifically those related to AI that did really well, for the first part of the year, were also the ones that went down the most during the sell-off. But again, that's normal, right? That's where people are going to take profits, is in the areas where they have big profits. So high volatility, high upside volatility early in the year will often lead to higher downside volatility when we have a sell-off. But I do think there may be some interesting opportunities. A lot of times these type of market sell-offs occur when there's a change in market leadership. So just like last year, we had the Magnificent Seven really led the market for the first part of the year. Then that started shifting. We had a downturn where the Magnificent Seven stocks were hit harder than others as things kind of normalized. And then we saw some other areas of the market really lead that rally through the end of the year. So, it could be that if this ends up being a fairly shallow downturn and we rebound from it, what we may see is different leadership coming out of this sell-off than we had for the first half of the year. So that's something that we're definitely paying attention to.
All right. Well, let's jump to the inherited Roth IRAs, IRS final regulations. We've talked about the Secure Act 2.0 and what it was created for. Maybe give us a bit of a refresh on that. And then let's get into the inherited Roth IRAs and really what those qualifications are for beneficiaries from the IRS.
Yeah, the Secure Act 2.0, it had a lot of, both the Secure Act and the second version had a lot of, positive things, mostly related to retirement planning and retirement accounts. But there's just been one area that we've touched on quite a few times in the past couple of years that has just been a real mess in trying to sort it out. And that comes down to the rules around inherited IRAs and inherited Roth IRAs. One of the big changes was, with those accounts, instead of being able to stretch them out over your lifetime, those inherited IRAs, whether it's a traditional or Roth, need to be fully distributed within a 10-year time period. And the original understanding was, okay, so that just means you have to take all the money out within 10 years. You can take it out whenever you want within that time period. And everyone kind of ran with that understanding. Then the IRS came back and said, no, actually, that's not the way they interpret the law. They say, yes, it must be fully distributed within 10 years, but you're still required to take those required minimum distributions each year that people have to take once they're over age 73, or that, historically you had even inherited accounts, you had to take it each year to stretch it out over your lifetime. So then we had to rethink. The IRS gave amnesty to anyone who didn't do it correctly initially, because they understood that the law and the guidance was very confusing. So now maybe we're finally getting to the end of this, which is the IRS saying with inherited Roth accounts, saying, yes, the 10-year rule applies, right? You must completely distribute the account within that time period, but there are no required distributions. So Roths do have that increased flexibility But there still are, a few little rules based on the owner and how old they were and things. So, I guess the bottom line is, this is still just a really complicated area. People should definitely consult a professional.
Yeah, well, it absolutely sounds like it. If there's one type that it just works differently, these are the confusing things that happen with the IRS. And like you said, you should always definitely contact a professional. And yeah.
Yeah,
Anything else?
if you saw an updated flow chart of all the different rules and examples and exceptions, it just makes your head spin. So, yeah, it's the Secure Act 2.0, which was supposed to simplify some things, definitely went the other direction with this aspect.
So, in a nutshell, you're saying that if you inherit a 401k, Roth 401k, traditional IRA, or Roth IRA, the required minimum distributions might work differently.
Yes, definitely. The rules are different than they were in the past. So, you need to understand that. And I would definitely recommend talking to an investment or tax expert.
Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. Got 2 items pinned up there, Mr. Armour. What do you have first?
Yeah, well, recently I was a guest speaker for the Financial Planning Association of Northern California. They've been doing quarterly symposiums on different topics. And this one was focused on the business of financial planning and actually how the industry has evolved. So it's a little bit different, focus. Normally we're looking at, how things have changed, new best practices to serve our clients. But with this quarter, we took a step back and looked at, the business landscape, right? Because a lot of us that do financial planning are small business owners. And specifically, the discussion was on the current mergers and acquisitions landscape within the financial planning industry. There's been a lot of private equity money and things that have come in to try and buy up smaller companies and consolidate them. But then also, as things evolve and, how do you incorporate the next generation into the industry as many baby boomers are slowly reducing their workload or retiring? Where are those opportunities for people to come in and take over their businesses and work out deals that that are good for both sides. So it was a good conference. I think the takeaway was that the financial planning industry as a whole is very healthy. There's more demand for our services than there are people to provide those services. So it makes it more and more important that firms really sit back and think about their business plan and have long-term plans to hire, train, and mentor the next generation, as well as, pass on those businesses, however that may be structured.
Absolutely. What's the second item we got pinned up there on the bulletin board?
Yeah, I think we brought this up a while ago, but I've seen it come up a few times, and so I thought it was good touching on again, which is, with interest rates now being much higher than they were a few years ago, what we're seeing is a lot of banks have been, kind of playing games to avoid paying depositors a competitive rate, right? So a lot of banks, they have increased the interest rates that they pay on their legacy accounts, but they've been doing it slower than the market rate. So those accounts may actually be a % lower than what comparable accounts are paying. And then what the banks will do is they'll actually create a new account type that pays interest rates that are in line with the current market rates. And that's the account that they advertise, right? We offer, 5% on money market deposits, and their existing depositors think, oh, good, they're offering 5%. That's a comparable rate. That must be what I'm getting, not realizing that they're actually in the old account that's only paying 4%. Mm-hmm. And really all they need to do to get that higher interest rate is, call their bank and say, no, I want to switch to this other account type so that I get the higher interest rate. Banks are basically banking on that complacency, people not realizing what's going on and not realizing what the actual percentage that they're getting. And so they just stay in those legacy accounts, and then the banks are able to get away with paying a little bit less in interest than they otherwise would if they were in those more current, updated, more competitive account types.
Yeah. Well, that's wonderful information. And I'm definitely took extra note of that to look into it myself personally. Mr. Armour, anything else you want to add before we wrap up this edition of the podcast?
No, just hope everybody's having a great summer and beating the heat.
Yes, sir. Well, hopefully you'll start to get down on the other side so that I can pay a visit and we can get in a round of golf. Okay, you play golf. I play something that resembles a ball and a stick moving. And anyways, we thank you all for listening to the Plan Solutions Incorporated podcast. Please hit that subscribe button on whatever platform you're on, Apple Podcasts, Spotify. We are now available on YouTube where you can follow along by video. And the videos show the personal financial review as Chase and myself discuss the different sections, and you'll be able to get that information there as well. And if you want to subscribe to the personal financial review, send Katie an email. That's Katie at plansolutions.com and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.